Markets for now seem to have digested. Can it last? That's the question that we put to Johan Jooste. He's the Chief Investment Officer at Bank of Singapore. He joins us right now from our studios there. Good having you. Good morning. Thank you so much for joining in. First off, am I pronouncing your name correctly?
Hello. Johan Jooste. You've got it all right.
All right, great. Thank you so much, Johan. Good morning to you. What's the sense here? Today, the markets have a bit of a calm, but with all the blows that both the nations are trading at each other, and it's not just China and US. I believe the other nations are weighing in as well on a multitude of issues against Donald Trump. What does all of this do to the investment sentiment across the world?
Well, sentiment is obviously not great. You know, you've seen it in Asia. It was overnight. You've seen it in the major markets, not as severe. It's creating uncertainty because, yeah, you say blows are being exchanged, but the problem is just this, is, you know, we still don't really know exactly. It's, you know, a lot of talk, a lot of threats, but it's tough to say, you know, it's going to be precisely, you know, this thing or that thing in terms of, you know, tariffs. And it's not the only thing in the market. There are other issues. There's monetary policy. There's, you know, what will the Fed do in response? Is this going to trigger a recession? Where's OPEC? Oil price going to move a lot up or down? You know, there's a lot of uncertainty weighing on investors at the moment.
The Fed has already shown its hand, Johan, and we kind of know what the dot plot is looking like, and therefore what to expect from the Fed. So one, correct. Can it throw a surprise? Correct. One, but two, more importantly, between now and June 22nd, what is the more important determinant for sentiment? Would it be the outcome of the OPEC meet? Because the markets seem to be now pricing in a better than what was earlier expected outcome. Or could it well be some more salvos fired by both the sides, be it US or be it China?
Well, if you say 22nd, I mean, we're talking Friday. I think in that short space, I would be surprised if oil price dominates. I think it's, you know, whatever news flow we see on the trade war, or trade spat, what you want to call it, I think that's what the market is focused on now. Remember, they've got until July 6th, thereabouts, to sort of finalize issues. That's what caused the rumpus so far this week. I think that's what's going to keep moving it. Keep in mind also from the oil price, you know, it really needs to move quite a lot to have, you know, major league impact in the short run. I don't see that being the major driver, to be honest.
Interesting. So, okay, let's work with an assumption that Donald Trump does carry out his threat of imposing tariffs on $200 billion worth of goods on China, and China would reciprocate, as they have said as well, and probably doesn't stop at that. What's the impact on markets do you foresee? Because I know investors by and large would turn cautious. I don't know whether it has the arsenal. These actions have the arsenal to really damage what the kind of growth that we see in the world at large. What is your assessment?
That's a very good question. I mean, I think the first point to answer about China and you know, what can they do in addition? They can pretty much, you know, not do all that much more in terms of tariffs. I mean, in terms of the total volume that the US exports to them, they're more or less there. They're sort of running out of road in terms of just adding tariffs to more things, and it doesn't make a real difference if they increase the level. Because effectively there's a barrier now, so whether it's 25 or 40%, the stuff's not coming in if that's, you know, the worst case. To your second point, where do we stand in terms of overall growth? That's actually the key to that sort of cuts to sort of precisely the whole issue on a longer term view. So the next few days sentiment can be bad and so on. It's extremely difficult for us as analysts to know how to sort of unweave this whole thing, because the supply chains are so complicated. You know, a tariff on one company can have knock-on effects right down to banks who've issued loans and so forth. So it's extraordinarily difficult. There's third and fourth round effects. So the market is going to continue to take, I think, a pretty cautious view of all of this. As it all plays out, I think there's at least a chance that, number one, there will be some sort of conciliation. And number two, I think to your point is, does this really derail the global expansion? Does this really mean we're going to tip into a recession? And I would put that as, at this point, probably still something of a tail risk. It's still not our base case. We think it might be something of a drag on growth. It might still be maybe something of a drag on investment. But it would be surprising that at the current scale, it actually tips us into a recession and makes the Fed change tack, for example, as you also point out.
Johan, how closely do you look at these flows from the emerging market, the outflows? And these are happening irrespective of the trade war concerns or otherwise. We almost have had a concern looming on the world markets almost every single month. So we've had month of inflows as well. But if I just take a look at April, May, and June, the way it is shaping up, at least in India and some of the other emerging markets, there's consistent outflows to the tune of $1 billion from India, at least, if not more. What do you make of this? And do you reckon that this is a phenomenon that could continue? Outflows out of EMs, maybe into DMs or select other asset classes?
Yeah, I think it's a risk. You see stronger dollar and you see increased funding rates, and investors just going generally risk off. So there's again, it's not a single factor driving this. Certainly in an environment when investors globally view risk as being elevated, they will trim down the positions that they think contributes the highest sort of variability to portfolios. That's emerging market assets. But then at the same time, I don't think EM assets, generally speaking, are particularly expensive. So anything of a stabilization, I think you will see a reversal, but that might be some way down the line. Just as investors come to grips with the fact that LIBOR is on the move up and the dollar is not going to necessarily collapse. And then if you look at it from a valuation point of view, assuming we don't get tipped into a recession due to the trade war, which, like I said, we sort of discount that not as base case, then I would view this as potentially, let's just call it a developing opportunity. I wouldn't say rush right back in there, but with underlying growth and reasonable valuations, you would expect the assets at some point to find a base.
One last question. How closely do you look at India? The flows notwithstanding, we've still managed to withstand the pressures because of the domestic flows into the country. What's your view on India currently?
I think we review India as sort of like, just make a very top level comment. If you look at EM, some countries have done themselves no favors. India is one of those where I think the domestic policy exudes at least a semblance of stability. Compare that to some of the other ones. You call them by name: Argentina, Turkey, one or two other ones that have not done themselves any favors. So again, on a relative basis, you'd imagine investors would probably be just a little bit more satisfied with, let's say, policy direction.